Hey, everybody, it's Jeff here once again with the Money Trekker podcast, and we're excited to be with you in another week. And we're going to talk today. Tom's going to come on and talk a little bit about Gamestop, kind of a circle back on what we talked about on Gamestop last week, understanding the markets a little bit better and really understanding this fallacy that the markets are so predictive of the future and everything else. Tom's going to kind of go back through last year, 2020, and talk a little bit about how the markets were not exactly the most predictive across the board there. We're going to talk a little bit about the stimulus because just literally about an hour or two ago, the stimulus was passed. So that was something that we were talking about last week, and Tom kind of he's going to run a little victory lap at this point on what it ended up being, and is exactly what he thought it was going to happen. And then our most interesting thing, and I'll let Tom introduce that. So hang around. We'll be right back. Hey, everybody, welcome to the show. It's Jeff Kikel here, and I have my friend Tom Kemler on with BK Wealth Consulting. Tom, how you doing today, my friend?
Tremendous, Jeff. Good to be here.
I know we're going to talk about GameStop, so why don't we get started with that? What's going on in the wonderful world of GameStop and Robinhood and the Redditors and all those folks?
Well, as we mentioned last week, I have a better analogy. These short squeezes are kind of like if somebody puts out some bread to rise and the yeast takes over and the bread rises and rises and rises. But at some point, the yeast stops working, the rising process stops. And I'm sure if you're a baker out there, you've had a cake collapse or some bread collapse. Once that thing starts to collapse and the yeast is no longer working, you can't resurrect it. You're going to end up with a brick or an inedible pie or cake or something. So last week, it was clear that the rising process had stopped. And so, all GameStop has been to crater. And so now we're into the what next phase. And this is really interesting because you're going to have some congressional hearings because people in Congress just can't help themselves. They've got to jump in front of something and hold some hearings to generate some sound bites that they can play on the evening news in their home constituencies. But so they won't really yield anything. But there still is going to be some criminal investigations. There's going to be regulatory investigations. And then there's just going to be a general thought about, what does this mean going forward? And so the first thing that we learned from this was that in extreme cases, and this was an extreme case, brokerage firms have powers that you don't think they have. Mm-hmm. And that's what happened with Robinhood, where they were basically demanded by the brokerages that they were trading with, that they needed to post additional collateral, and ultimately ended up being over $3 billion worth of additional collateral to deal with all of the risk of them trading GameStop and these other stocks with Robinhood. And that's one of the reasons why they did forced liquidations. They did trading freezes and what have you, and raised margin rates. And they have the power to do all of this. I know a big player in this whole thing has been Dave Cortnoy of Barstool Sports. And
Mm.
From what I've seen of him, I like Dave. He's kind of a funny guy, and he's really kind of put himself out there, at least as far as being a trader. But one of the first things that he said after GameStop was, "Well, I didn't know brokerage firms could change the rules in the middle of the game." And note to Dave, I'm sorry, but they can.
Again, and it cost him, from what I heard, I was listening to the interview with him, he lost like $750,000 on GameStop of trying to trade it during this craziness.
I think he lost a little bit more than that. But,
I'm sure he did. Yeah.
Anyway, but yeah, in the fine print of virtually every brokerage firm customer, including ourselves, has ever signed, there are provisions in there if stuff gets crazy that they can demand additional collateral and what have you. The second thing that I think that GameStop puts to the forefront is the whole idea of what's called a settlement period. And this is a little bit of inside baseball, but I just have to touch on this for a second, because when I got into the brokerage business in 1985, the settlement period was a week. So, and in those days, there was a lot of people actually held physical share certificates. And so if you called your broker up and said, "I want to sell 100 shares of Exxon," he would sell it. And you had a week to trek over to the brokerage firm, put in your certificate, sign the back of it, and close the trade out. Well, aside from some antiques, there really nobody gets certificates anymore. In fact, I don't even think you can get one, even if you.
I don't think they have them anymore. It's all electronic. Yeah,
it's all electronic. So as we move to electronics, they cut the settlement period from 5 days in the 80s. In the 90s, sometimes they cut it to 3 days, and then more recently, in the last 10 years, they've cut it to 2 days. And a lot of people think that it should be instantaneous, that and including myself, and or at least 1 day, because this float period, with everybody having a checking account online, you can't float checks anymore. And this is kind of like the same thing. And so this settlement period raises the uncertainty, because if you're a brokerage firm that has had your clients sell and other clients buy, and the corresponding brokerage firm has 2 days to deliver that stuff to you, and the stuff is moving by hundreds of dollars a day, it creates a lot of uncertainty. So I think that one of the real world solutions here is going to be that they're going to cut the settlement period. 2 days is way more than enough. I think it should be same day, 1 day at least, and that'll probably happen pretty much this year. I do have to give a mea culpa at this point, because I did say last week that I think that we would have seen a major hedge fund go belly up. We have not, other than the Melvin Capital that required the cash infusion. I haven't seen anything else, and there's been actually some stories about a few hedge funds, as we talked about, you and I, the possibility that there were some hedge funds that had jumped in on the side of the Redditors and were pushing to make some profits of their own. And I read about one particular group in the Wall Street Journal that had made pretty good money in AMC, squeezing the shorts. So it was interesting to know, and pretty obvious to think about that. That the hedge funds could see the power of the Redditors and jumped in and took their side when they thought it would help them. The final thing, though, and this is really, as GameStop goes away, the question really becomes going forward: can this happen again? And part of the answer to that represents is who came out of this with relative strength, and part of that is did the in aggregate, did the Wall Street bets / Redditor crowd, did they gain overall dollars that they can put towards something else? I think the answer to that is yes. And I think maybe by a lot. GameStop is still, I think, over $50 a share. And so some of these guys may have lost a lot on paper, but they're still way ahead. And here we are talking a lot of times when we're talking about investments, we talk about investments being a thing where everybody can win. You can have a slice of a growing pie, and as long as the economy's going, you own stocks in companies that are growing, your success doesn't have to come at the expense of somebody else. And that's usually what investment firms like ours, that's the normal course of action. Mm-hmm. However, in very small little worlds and the shorting and slash short squeeze world, it is a zero-sum game. And so there are winners and losers. And so it really does come down to who came out of this with ammunition to do it again. Does the GameStop Redditor crowd have enough ammunition to go forward? I think so. One is in numbers. Before last week, the Wall Street Bets Reddit subreddit had supposedly 2 million members. And then in 1 week, that went to 7.5 million. So there's more people in there. Mm-hmm. And whether or not they're going to commit money, I don't know. But then the second really comes down to the dollars. And there's a few analogies that I would use for the dollars. The first one is one of the most successful investors in history is a guy named Carl Icahn. And Carl Icahn is I think he's about the same age as Warren Buffett. Doesn't quite have as much money as Warren Buffett, but he's still a legend. He's been a legend of Wall Street for decades. I remember reading a piece about Icahn years ago where the SEC was looking to fine him. He had done something and they had investigated him, and they were either proposing fine or jail time or something. And I think he was willing to actually go to jail. And his point was, he goes, you can't, because they were looking for something like a $2.5 billion fine. And his point was, he goes, my money is my army. I can't surrender that. So I need my army to carry out the kind of things that I need to do. And so, put me in jail. He didn't end up doing either, but I thought that was a very interesting point. It says he's deploying his cash on the board like if you're playing in a game of Risk and you want to get more and more guys under your control so that if you come up against somebody, you have the firepower to win. And a similar analogy is if anybody's ever watched like the World Series of Poker, and you see the final table, and you look at, they'll talk about a guy who's short stacked versus the guy who has all of the chips. And the guy with all of the chips can dominate. He can push the guy that's short stacked around. He can force him into positions that he doesn't want to be in, purely because he's got the money to bet and make him have to react to it. So all this being said, who's got the stacks? And, I think that the hedge funds probably, not that they're going to have no money, but if you looked at hedge funds having a stack like this and the Redditors having a stack like this before GameStop, I think the hedge funds came down a little bit and the Redditors came up a little bit. So my feeling is that the Redditor GameStop people, they've got some profits. None of them got out at the top, or very few. But probably a lot of them made some money. And so this is going to come up again, and they're going to search around for another pressure point. It's going to be interesting. The last thing about that really gets into the idea of, there was this populist idea that the Redditors were, the masses, and the hedge funds that they were fighting are the one percenters, and there's some truth to that. But as we go forward, I think that there's going to be investigations. The SEC's already said they're looking at whether or not there was market manipulation by the Redditors. And what I would say is, you look at the establishment, all of the hedge funds, they have these conferences like the SALT conference and the SOAN conference and a zillion conferences in Manhattan every year, where people pile into a hotel room, maybe get a dinner, maybe get a few drinks, and then they get up on stage and they hear each other's ideas. And so I don't see the difference between going to a conference like that and hearing a guy say, you should short GameStop, and then being in an online forum where a guy says, there's too many people short GameStop, we should buy it to squeeze them. So if they're going to call the latter market manipulation, I think that that's just a double standard. But that's just me. I think it's going to be a question that's going to be examined, and the regulation process is going to take a while, but I think there will be something else in the meantime, because I think the Redditors have come out of this with a scalp. They've got some momentum, and they probably have a lot more money collectively in all of their accounts. So the people, and I've read a number of snooty institutional investors this week are like, oh, eventually all those guys are going to go broke and they're going to go back to delivering pizzas. And that's wishful thinking on your part. I think in this case, they reached in and they took some of your hide.
Watch out, bud.
And that may happen eventually. I'm not saying that this is going to last forever, but I think at least in this game, I think that they came out of it with some stuff.
Yeah.
So all that being said, on GameStop, I wanted to switch gears a little bit and take us through our usual economic charts.
Okay.
And so to do that, I'm going to take the screen.
Oh, hang on. I think I need to give you access to it. Hold on. All right, you got the con.
And okay. I always forget that Simon Says share button after. Yes, I really want to share.
Yes.
So you should be seeing the PMI manufacturing final. Is that what you're saying?
Yes.
Okay, great. We've been talking about, when we have been looking at the numbers that come up in the weekly reports, that we're really just going to concentrate on the reports that are kind of blowouts in either direction.
Mm-hmm.
And the stuff that's consensus is going to be, I'm not going to say forgotten, but we want to focus on the stuff that's really pushing the needle. So this week I found, of the high profile reports, I found 7 reports that met our standards. 5 of them were positive blowouts, 2 were negative. And then I have an 8th chart to just show you at the end. So the first one, this PMI number came out on Monday. This was, you read the consensus outlook. The flash number was much higher than expected. They thought it was going to sag back to 58. So what happened? We have a classic prior number was 57.1, which in and of itself was pretty strong. Mm-hmm. They revised that up to 59.1 and then figured, well, as much as we can do after that is going to be to sag back to 58. And here's the range of consensus. And the actual number came in stronger than everything. So this is the Purchasing Managers Index for manufacturing. So this is what's in the pipeline for the manufacturing sector, which is, there's a lot of value added. Those are good jobs. This is a great number to see for our economy. ISM manufacturing. Now, I don't understand why the ISM manufacturing index and the purchasing managers index could be so different, but this is one of the losers. The ISM is Institute for Supply Management, and the only thing I can think is that the purchasing managers index is looking forward because it's purchasing managers saying, yeah, we're ordering more stuff, and the Institute for Supply Management is actually looking at the actual manufacturing and saying, well, as of right now, we cooled off a little bit. So this is one that meets the definition for a weak report. The prior number was revised downward. The consensus was for a small decline, and the actual number came in much lower and below the entire consensus range. So here we are, 1 and 1. This number looking for manufacturing in the future to be stronger. This number saying manufacturing right now is slowing down. Mm-hmm. ADP came out this week. This was a number that this is a private employment report. So this is January. This came out on Wednesday. Prior report was revised higher. It had been negative, and they revised it to not so negative. And then the consensus number was going to be positive, and then the estimate just blew out the consensus number. So, that was a positive. This is a purchasing managers index composite, and before the PMI was just for manufacturing. This is for all purchasing managers, and this one showed very strong numbers. The prior numbers, the consensus and the consensus range, and then the actual numbers coming in above consensus. Institute for Supply Management Services, similar deal, prior number here, 57.2. And by the way, can you see these numbers really good, or should I read these out?
No, they're good.
Okay, because I'm just pointing at them, and I'm hoping that somebody's just not like, what the hell? I mean, he's going too fast. But,
it's just a bunch of jumble of numbers and a bunch of acronyms.
Anyway, 57.2 revised up to 57.7. Consensus was going to be 56.8. The actual number blows out the consensus range, 58.7. Jobless claims. Now, this is a number that week after week, I think gets mischaracterized. And this week was no exception. It comes out Thursday mornings. I looked at my phone when I was getting coffee Thursday morning. Jobless claims, another 779. Like it was just horrible. Here's the prior number, was 847. Prior revised upwards by 25,000. Consensus was for 835. Comes in at 779, below the entire range. Mm-hmm. So, that's a big number, but it wasn't anywhere near as bad as anybody thought. Productivity number, then, this is the other, the second negative of the week. Productivity last quarter was revised higher, and it was expected to drop back, but it dropped back a lot farther than was expected. Unit labor costs the same. They had been low, they were revised even lower, and then they bounced back even higher. And usually these two are going to go against each other. And you think about it, if unit labor costs are rising, it's because people aren't as productive. And so productivity goes down when unit labor costs go up, and vice versa. You get more productive, your cost of labor per unit is going to go down. So this was a bad report after a good report. Today's number was another one that I just put this up. It doesn't meet my new standards, but I thought I would throw this out.
Well, but it's interesting, when you compare that to ADP, how different it is.
It's always different than ADP. They do march in the same direction, and if you look at some stuff over longer periods of time, they definitely correlate much better. But month to month, the numbers are different. Mm-hmm. the reason I wanted to point this out today was that, again, the first thing that I saw this morning on my phone was the employment rate stinks.
Yeah.
This is just a bad number, and I'm like, really? So I went in and looked at it, and so the consensus was for a gain of 50,000. Well, the actual was 49. That was pretty close. The range was from a -100 to a 400, so kind of in the middle of the range. Mm-hmm. Unemployment rate, that's a weird number. I don't get that we could drop 0.4% when just a gain of 49,000. There's something about maybe going into a new calendar year, something inside baseball behind this that may, because what this implies is that by the Labor Department's methodology, it implies that a lot of people gave up looking for work. Mm-hmm. And therefore, if they gave up, they're not really considered to be in the workforce. And that's why the unemployment rate went down. Yeah, I can't think that would have caused a 0.4 drop, which is pretty huge.
Yeah, well, and I mean, the participation rate didn't really change between the two. So
exactly, yeah. So there's something off about that, but I mean, it didn't go in the positive. It didn't go up, and so in a really horrible report, this might have been 7.1, and then everybody would be tearing their hair out even more. Private payrolls missed 6 to 35, but if you look at that range, manufacturing was negative. Now manufacturing missed. Mm-hmm. Participation rate, as you noted, right on. Our average hourly earnings was a bit light, but still in the range. Year over year, average hourly earnings, though, were above the entire range.
Yeah, that's pretty strong. I mean, that's really strong. That big of
the average work week at 35.0 hours is really high. I mean, for years, I've seen the average average work week at around 34.5 hours. So the fact that it's pulled up to 35 suggests a lot of people are getting full-time jobs. So these are not part-time jobs delivering pizzas. So this has been portrayed in the financial press as a terrible report, and we're just tearing through this and saying it's not. And so this just kind of is a segue point for what I was going to say more generally about the markets, and that is that, and I'll be the first to admit there's a lot of hubris in the financial markets. No hubris here. But
what do you mean hubris about talking about Robinhood traders that they're going to go back to delivering pizzas?
Those guys are the hubris guys. Exactly, the hubris guys. No, but they'll say, well, the market it anticipates the future, and they'll point to this or that. I don't think that the market anticipates the future any more than you or I know the future, which is. Sometimes if you're standing on the railroad tracks and you see a train coming straight at you, if you don't get off, that's going to be a problem. So to the extent you can see the future there, okay. But I think when you look at some of these studies that say the market will anticipate the future, that's kind of, it's self-serving. And my feeling and what we've kind of demonstrated by looking at these charts for the past year is that the market operates in real time. Mm-hmm. And if anything, it's reactive, not proactive. And the example I'll give, and we'll just take a minute and go through 2020. I started reading, I'm a news junkie. I read as much as I can on news. I started reading it was the week between Christmas and New Year's of 2019, and I started hearing about this strange virus in Wuhan, China, and how there were people dropping dead, and how there was all these internet chat rooms that were kind of on the hush hush talking about this, and all through January of 2020, that just kept getting louder and louder, and we've all heard about, the WHO weighed in and said, oh, it doesn't do anything. And, even as late as the end of January, I think it was even January 31st, Dr. Fauci said, this isn't going to be a problem for us. We're okay. Those guys over there, they're a third world country. They're going to have trouble. We'll be fine.
Don't wear a mask. There's no need for it.
And the whole time the market is just chugging January, setting new records. We get into February. So, the news is getting louder and louder. More and more people are dying. All of a sudden in February, it's in the United States, and some people start dying in nursing homes in Washington State, and the market takes a header. Well, it wasn't anticipating any of this, and it wasn't even following it in real time. It was only once it was delivered to the doorstep that we fell, and we fell hard, for a month till March 23rd bottom. And then you and I started doing these things. Mm-hmm. And one of the things that we were doing was saying, because once we get to March 23rd, everybody's like, we're going back to the dark ages. This is horrible. Sell everything, buy gold, buy canned foods, whatever.
Toilet paper. Don't forget toilet paper, Tom.
You couldn't buy toilet paper. There wasn't any there. You could use your Kruger hands to go buy toilet paper on the black market, I suppose. But anyway, but we're looking at these kind of charts, and we were saying, I don't see it. I just don't see it. And the market was starting to repair itself, and we got through the spring and into the summer. And the financial negativity was relentless. It kept saying, we shouldn't be going up. And we kept saying, this is what's happening in the real world. And the market was really responding to it. And so the reason I'm saying all this today is that we had nothing but better than expected news on the economic front from April on. And it just helped the market continue to go up. I mean, we're overheating in some places. The real estate we've talked about a lot. And my most interesting thing is another overheat. And we'll get to that in a second. But so we're here, and just to tie a bow on all of this. A lot of people, not only a new year, but a new administration in Washington, a lot of people are proclaiming that they can see what's coming down the road. And they're wondering, well, why is the market still going up? And we just went through it. We had 5 reports this week that blew out to the upside. Mm-hmm. Only 2 were negative. The rest were as expected. And so overall, things are still doing better than expected. And so
the ones that are in the positive are the real key areas that keep the market chugging along. So
exactly. So we're here at the Wall Street Journal. What's funny about I've got Gamestop. You can't even get a quote half the time on the journal because it gives you this weird page. This is not the normal page that you should get. You should get a chart. So GameStop is still being traded. Look at that, 74.7 million shares. Remember, there's only 70 million shares outstanding. So
unbelievable.
Again, even today,
100% of the float just about every day,
or more. But it's down to 60, and so it was like 200 last week after hitting 500 in the middle of the week. But what I wanted to talk about for the most interesting thing as we go out to the end, and this is about markets overheating, is this chip shortage. Now, this is, maybe I'm a little late to this party, but I started hearing rumblings about the chip shortage back before Christmas, and maybe I'm kind of dense, but I have to hear something again and again and again until I'm finally like, what's going on here? So, finally today, I see Ford Motor comes out and says, we got to shut 2 factories that are making F-150s, which is their most profitable vehicle by far. I mean, if it wasn't for the F-150, Ford would be bankrupt. And that's not hyperbole. That is, they have to make F-150s because they don't make any money on anything else.
Mhm.
And so it's going to cost them $2.5 billion to shut these factories down to make F-150s because they can't find enough chips to put into these things. And just as a kind of an example, somewhere around, there's about 100 microchips in every vehicle nowadays. Some have even more, 150. So with all these chips that are going into everything from the touch screens and all of the sensors and everything else, if you don't have the chips, you can't make the vehicle. And that's where Ford's at. So I'm thinking, like the chip industry is pretty robust. How did we all of a sudden get to a chip shortage, and a chip shortage that has been lasting, started basically in July, and it's been slowly getting worse. And now 6 months in, we're hearing that it's as bad as it's ever been, and it's going to take at least 6 months to resolve. And so I dug into it a little bit. There's no smoking gun, but there are a lot of interesting things that I learned. One is that a lot of people have the chip makers are blaming the automakers, and it's not just Ford; it's all of them. GM, Volkswagen, Fiat Chrysler, Nissan have all publicly come out and said we're going to lose a lot of money because we can't make as many cars as we need to because of the chips. And the chip makers are saying, well, you guys have gotten with this lean manufacturing so much that you don't keep enough inventory on hand so that when your demand spirals up, you just lay it on us, and you don't have anything. And to some extent, that's true. The whole global idea of the just-in-time manufacturing that the automakers use is that everything's got to be lean. You don't want to have. They don't want to have anything. They want to have a train load of bumpers come from the bumper maker, just unload it straight onto the assembly line. They don't even want to keep it anywhere. And so there's some truth to that. And what they're saying is that the automakers, when COVID hit, I know some people that went out and got really good deals. If you had the cash, you could have really driven a hard bargain in April and gotten a nice vehicle for a lot off. But that turned around pretty quick, and the auto market is as hot as the housing market in a way. So you had that. There's a lot of people that are saying, well, there's a lot of people took stimulus checks and bought Xboxes and Sony with it, and there's some truth to that. Another angle is Bitcoin mining and Ethereum and all of these various digital currencies. That they require a lot of computing power, and so there are people that are building these custom-made rigs to Bitcoin mine with. In fact, I read an article. It was in the Journal a couple of weeks ago. It was kind of fun about how much heat these computers throw off, and so there's these people that are Bitcoin mining in like Finland or places like that are heating their houses with their computers. They have these tricked out computers. Or one guy had his CPU, it was heating his chicken coop, keeping his chickens warm. But they really use a lot of electricity, and you need a lot of computing power because one of the things about Bitcoin is this mining. And you got to use all these complicated algorithms, and there's only so many Bitcoins out there, and all the low-hanging fruit has been taken years ago. And so there's only so many Bitcoins. And so what they're doing is they're having to climb an ever steeper mountain, use ever greater computing power to get that next coin. And there's so few coins left, and you have to use so much to get it, that it really uses a lot of computing power, a lot of chips. And as a result, people will, but they're doing it because, Bitcoin's almost 40 grand a coin. So there's the motivation there. And just one last thing about Bitcoin that I thought was intriguing was that a different thing. This isn't quite a chip shortage, but there are a number of countries, and they're usually poor countries, countries like Iran and Venezuela, where electricity is essentially free. They do that to appease the people. They don't have much else, but you get free electricity. Well, it's turning out that that those countries are huge Bitcoin miners, because these people are taking advantage of the free electricity and just running their computers on it and mining Bitcoin. The last thing that's all on the demand side. On the supply side for the chip shortage, I came across something that was interesting, and I'm going to have to read it because I wrote it down. Angiomoto buildup film, ABF. ABF is a fiberglass-like fabric substrate that is it's essential to chip production, because you have to have something to put the chips on. And there are very few manufacturers of this substrate. One of them was a company called Nitobo. They had a fire in July of 2020 at their plant, and it was a pretty bad fire. And apparently, even worse damage was that they used so much water to put the fire out that it messed up the equipment that they had.
Oh, geez.
And so they make this ABF film, the Angiomoto buildup film, and that's caused a bit of a shortage. So I found 3 other companies that make this ABF film. 2 of them are in Taiwan and one's in China. The one in China is called Nanya. In Taiwan, there's Unmicron and Kinsis. Unmicron itself had 2 fires.
Oh, geez.
It had a fire in October and then another fire yesterday. And in the meantime, the Nanya one in China has had no fires. Not saying there's a conspiracy theory there, but it is interesting. But the fires are not hitting the Chinese guys.
And if it did, they'd never say anything about it, so it's perfectly fine. The
other thing on the supply constriction front has been 8-inch wafers. And again, I'm not a chip guy. I'm learning a lot of this, but my understanding on 8-inch wafers is they're old school. They're not cutting edge, and as a result, nobody's been investing in 8-inch wafers. Well, as we've gotten into this shortage, people are digging through the inventory essentially and saying, well, we got to make whatever we can make. And so now there's a huge shortage of 8-inch wafers that everybody thought were going to be obsolete. And what has exacerbated that issue is there's a company, it's a Chinese company called Semiconductor Manufacturing, SMIC. They make 8-inch wafers, and the United States, by way of the Pentagon, just blacklisted them, like, I think this week. So that's part of the shortage. The SMI stuff is out, and then there was another company AKM in Japan. That had a massive fire in October, different deal. So there's a lot of fires in the semiconductor supply chain. And then a third major manufacturer of 8-inch discs or wafers, DB High-Tech out of South Korea, they are making coin. They said that they have been running their plants flat out for 6 months, nonstop, and they don't anticipate taking their foot off of the floor for at least another 6 months. So that is the chip shortage. As I kind of put a bow on that, I start to think that, a lot of times I've haven't been in the finance business as long as I have. You hear about these shortages come up and you're like, is it, by the time I hear about it, is it just about to be resolved? And so I don't know if we're in that or not. It seems like if the big boys like Ford is coming out and saying, we got to shut some plants down right now, it seems like it's certainly spreading. And it's not one of these things that is already on the mend. The big winner here, supposedly Taiwan Semiconductor, is but Taiwan Semiconductor, you look at this over the last year, it's tripled off its March low from 44 to 128. So a good bit of that is baked into it. But anyway, to the extent you haven't heard about the chip shortage, there's a lot of fires and a lot of demand.
Yeah, but not in Chinese factories.
No, not in Chinese factories. So that is
all right.
That is Friday, February the 5th.
That was a lot. Well, Tom, thank you so much for putting all that together. Once again, I agree with you. I think, we've followed the numbers for the last year, and I think it's been pretty dang obvious, but apparently we're just not the prognosticators that the Wall Street elites are, along the lines of Punxsutawney Phil. So,
6 more weeks of winter.
6 more weeks of winter. Of course, if he had seen his shadow, it'd be 6 more weeks of winter. But whatever. But good to know.
Until spring, there's a difference.
Well, true. Yeah.
Now, here in Texas, there's not that much of a difference. But I can tell you, the friends and family I have up in Pennsylvania, there's a big difference.
Yeah.
And there's some emotional investment there.
Well, but then they're all cheering at the thing with the stupid rodent. I'm like, come on, are you crazy? What, you want more of this?
It's a lot of fun. I still love the movie with Bill Murray in it about it. If you haven't ever seen that, you ought to go. You ought to watch.
One of the few movies I've ever walked out of because it drove me nuts. But
you didn't like it?
Yeah. I'm sorry. That was the decline of Bill Murray movies. So they were all genius up to that point, and that was the tipping point on the downslide. So there were no.
That was like 30 years ago.
I know there were no good ones after.
He's had quite the decline.
Yes. Yeah, he keeps making movies. They're just weird. So. Well, good, man. Well, thanks a lot, folks. Make sure that you sign, however you're seeing us right now, make sure you subscribe to whatever channel you're watching us on. We are on YouTube. We are on Rumble. We are on Apple Podcast, Stitcher, Spotify, and we're on Google Podcasts. So wherever you're seeing us, make sure you subscribe to the channel, because there is going to be, over the next several weeks, a few bonus episodes that are going to kind of pop in there. And if you are not subscribed, we're not going to tell you about them. So, and there'll be some good stuff. So motivation to do it. Sign up, subscribe to the channel. Please, if you have the opportunity, please take a few minutes and give us a rating, 5 stars, please, if you can, because that helps us out immensely. and make sure that you make some comments and give us some information, because we can take that and create shows around it. So with that, thank you a lot. We'll see you back here next week. We're on 2 days a week and a few little extra bonus pieces here and there. And Tom and I will be back here next Friday for our Friday Financial Focus. So we'll see you then. Have a great day.